Good afternoon, everybody, and welcome to the Secrets to Cash Forecasting Optimisation webinar. Today, you are joined by myself, Winston Pearson, and my lovely colleague, James Higgins.
Good afternoon, everyone.
We'll be going through this webinar. Should take about 30 to 40 minutes, discussing the secrets of cash forecasting optimisation. If you have any questions throughout the webinar, please send the questions across. We will try to keep our eye on the questions box. And if we don't get to them throughout the webinar, then what we'll do is at the end, we have an allotted 10-minute period for questions. So we'll revert back to those questions and then answer as many as possible. Any that we don't answer, then we'll be sure to follow up with each of the participants to make sure that you do have an answer by the end of the day. Okay, so let's get started. Okay, so the webinar will be based upon the much coveted cash forecasting optimization playbook. If you've already read the playbook, fantastic. This will be a bit more information for you. If you haven't read the playbook, not to worry, we'll bring you up to speed very quickly.
So the story so far. We're going to set the scene here with a couple of fictional companies, Awesome Co and Busy Co. Awesome Co is a cash-rich company with good cash flow, plenty of liquid assets and low liquidity risk. And Busy Co, by contrast, although highly profitable, rely upon debt financing for their daily operations. Now, we're fully aware that the majority of companies will have a mixture of cash balances, liquid assets, revolving credit, other debt options, but for the basis of this webinar, we've treated them as completely separate organisations with very distinctive characteristics, i.e. cash-rich versus highly debt financed, in order to help explain some of the techniques involved in cash forecasting. We'll take you through the different levels of maturity for cash forecasting, from an organisation with a non-existent process all the way up to a fully automated forecasting process. However, no matter where you or your organisation sits on the maturity scale within the automation, it's important not to forget the foundations and best practices to ensure a continuously reliable forecast. Once a thing of art and intuition, we're going to explain how to apply some logic and structure to cash forecasting, increasing the accuracy of those forecasts and the reliability of them going forward.
Okay, so some of the goals that each of the companies would want to get out of this are on screen now. So what you should be seeing is really for Awesome Co, who are very cash rich and liquid. They're looking for increased returns on their cash balances, a reduction of idle balances on their accounts, being able to easily identify operating and non-operating deposits, and to reduce the manual effort around their daily positioning. Busy Co, in contrast, are looking for timely and accurate payments to their suppliers, foresight for short-term borrowing requirements, and a reduction of borrowing fees. Okay, and some of the challenges that both of these companies are currently facing is they have no long-term forecasts, which lead to a reliance on overnight placements and deposits. Their treasury functions are very manual, and whilst they do have a TMS in place that is used by the group treasurer, their treasury analysts are currently using Excel and online banking, and there's no consolidated view across the company for all of this information. Okay, so get your ducks in a row. Some very cute ducks. The first point that we want to touch upon is access to all of your banks and their account balances, or at least the largest value and volume of your accounts. The reason for this is for good reason. It's because you don't really know where you're going until you know where you've been. Okay, I've stolen that quote. You were warned that I do like a good quote, and that's Maya Angelou. And the reason for this is we just need to get the basis information, which is your account balances, before you can start any good forecast. Okay. The next part is consolidation of information to your treasury team, and what we're looking at here is more than just data. So we're looking at bringing together all of the in-house business units on any subsidiaries which have information which can contribute to the forecast. So if we use the example of an accounts payables receivables, the finance team, maybe a shared service team within the corporation, is you want to be receiving data and information from these business units which is valuable and in a consistent manner. Okay, so this is data such as your accounts payables and receivables ledger positions, as well as information supporting that. And so the insight supporting that would be if you have a discrepancy, a 5 million increase in payables in any given day, some insights as to why that may be. What we find best is to agree templates with business units so that they can send you these templates on a daily basis, whether that be an email template with the information included, or whether that be an upload template in an Excel format with the line-by-line data included for the accounts payables and any other information that may be available. And again, if you set an agreement, if you have a tolerance in place with those business units, then they can provide insights when any of the movements go beyond the norm.
So Winston, at this stage, I think you're talking about trying to build relationships across the business to be able to access this data, and actually you can improve your forecasting processes simply by establishing lines of communication and channels with the various different business units. Have you seen any particularly successful methods in terms of how this information is provided to Treasury that encourages some of those stakeholders to continually send the information?
Yeah, it's certainly the case that having those open lines of communication do help and do encourage the other business lines to send the information across. Not least because it's often the case that when people are doing their day-to-day role, what Treasury doing isn't the front of their minds. It's not what they come to work for. So having those open lines of communication really does help. As when somebody identifies actually this is beyond the norm, it gives them a prompt to say, I should probably inform Treasury about this. Those open lines of communication start with an education of other business units to explain the impacts that their actions and that their role does have on the Treasury of the organisation. Some of the best practices that we've seen, or that I've seen, James, is really around having email templates. A lot of business units do have checklists, and if one of the checks on their checklist is to send an email and the email template is pre-formatted to Treasury on a daily basis or on a weekly basis, informing them of any additional movements, any ledger positions, anything that's outside of the norm, this really just works as a prompt, and it encourages people to share that information, those insights, with the Treasury team.
Sounds good.
And then the final point that we touch on for getting those ducks in a row is a Nostro reconciliation that is reviewed and trends identified. Now, this is a Treasury function, and this is really knowing what your forecasts are, and if your forecast is perfect, ideal. But if it's not, and I would say no forecast is 100% accurate, it's really going back and reviewing and identifying trends as to what it was, what were those rogue movements, what were those delinquent actions that kicked your forecast out and made it less than perfect, and making sure that you're going through that historic trending and identifying those trends will really help in the future for building a more accurate forecast. Okay. So if we work through how to start a forecast, so we're on the beginning of the maturity scale, and we're taking those first few steps. As we said, we want all that balance information. So let's start with our opening balances and getting these across your banking estate.
And where's the best place to start with this, Winston, in terms of getting your opening balances? Where's the lowest level of the maturity scale? Where do people typically go to get the most accurate opening balances from? What data source?
Sure. So most people are using online banking. Okay, so they're logging into their online banking portals, and they're either taking a copy and paste of what's on the screen, or they're downloading statement reports and then using those offline in an Excel format. You can of course mature, and there are other methods that you can retrieve those via. As you start to mature, then you'll be looking at things like host to host. Maybe you may mature onto the Swift network, and even further you may start looking at the AISP or the PSD2 solutions to retrieve that information, but that is much further along the maturity scale. So most people at this stage are using online banking. Okay. Next, you want to include your accounts payables and receivables, or any other ledger movements. These are where those open lines of communication are useful. If you're getting this information sent across on a daily basis, then you can get this, a snapshot for a daily positioning forecast. if you can get this information forward value as well, let's say on a weekly basis, then it allows you to start building up that future, that more strategic forecast as to what have you got in the pipeline, what's due to happen on your ledger, on your accounts payables and receivables. Including any treasury activities that you're aware of. So if you have any money markets forward value are due to mature, any forward value FX, or any other treasury movements that are in there, other known quantities, then it would be really useful to include those as well. So that could be things such as if you have any debt financing, any loan repayments, or even any redemptions that are due in on any securities that you hold, or people hold of your own debt instruments, should really be built into this forecast at this stage as well, just to give you a base level for a solid forecast going out into the future.
Any other examples of known quantities that you can give us? I suppose what you're really trying to do here at the start of your forecast is identify those delinquent actors in the payments and receivables chain, identify any patterns and trends of people providing poor quality information or no information at all, right?
Yeah, so the other known quantities, this will really be populated from that identifying those trends, from that reconciliation that we've just touched upon. And the reason for that is because if you are seeing that, you're being told by whether it's an internal business unit or whether it's a market movement that things are expected to happen, but you're identifying trends that they're either happening late or early, then these other known quantities allow you to build that logic into your forecast. They allow you to preempt that there is a delinquent payer, that you're going to receive those funds a couple of days late, as well as maybe receiving funds early. Okay. The next point is implementation of KPIs for monitoring your accuracy. So not only do we encourage you doing a notional reconciliation the following morning to just check your both daily positioning, and if you're looking at this on a monthly and quarterly basis, doing the reconciliation on those bases as well, but really putting in some KPIs which will hold you to account and really force your accuracy in one direction. That's not the boy band, just to clear that up. But that it will force it into that direction because you always want to improve on your forecast. As I said right at the beginning, no forecast is perfect. So we really want to make sure that these KPIs are identifying when we fall outside of what we deem to be acceptable, whether that be 65% initially, moving up to 75%, so on and so forth, and always move that in the correct direction. And the way that you're going to do that is through the reconciliation, through identifying why you were not perfect in the first place. Okay, so these KPIs are really valuable. Okay, and that last point is the log of all discrepancies. Okay. Moving on to maturing your forecast now. So James, initially you asked how do people at the first stage retrieve their opening balances and that balance information, and I said, well, online banking. Of course, there are more ways to that with the Swift network, using host to host. I've seen some people use online banking and some strange scrapes which sort of pull all that information down themselves. Don't recommend, but it is definitely on the maturity scale. So there are ways of automating that balance retrieval, and what that means is it frees up the time of the treasury analyst who's no longer logging into these online banking portals and getting the information. It puts it in front of them as soon as they walk into the office. So it means that their time can be spent analysing the data, analysing that information, rather than doing the data gathering around that. Okay. Intraday updates. Intraday updates are always useful, and to truly mature your forecast, I would recommend that you do start receiving intraday balance updates across your banking estate.
So you're talking here about, because of course the intraday updates are going to be still going to be about what has happened, but this is going to continually refine the forecast, particularly for a daily forecast, a short-term forecast throughout the day, to reconcile those statement entries against your ledger, which comprised your initial forecast.
Yeah, exactly that. And the beauty of having intraday updates for a forecast as well is it really allows you to identify what you weren't expecting as well as what you were. So if someone pays you funds that you weren't expecting, it could be a day early, it could be a week early, it could be a month early. It allows you to identify those funds immediately, same day, rather than getting to the end of the day. The next day you identify that you had funds on your account, and then potentially you've breached exposure with a banking provider because you weren't expecting those funds. And this just really allows you to refine that forecast. Bearing that in mind, it also allows you to tweak your forecast for the future if you've received funds that you weren't expecting, but also if you received funds earlier than you were expecting as well. You can't just carry on your forecast as you were, because some of that forecast has already happened. So the intraday updates really allow you to change and amend and work with your forecast on a much more fluid basis.
And again, what do you recommend is the best way to obtain those intraday entries?
Sure. So again, going back to the ways that you would retrieve your opening balances, there are the same methods that you can retrieve this information. You can retrieve this information via your online banking portals. Again, you can log in and download this information. You can imagine doing this throughout the day is a bit more time consuming than to just doing a once in the morning pull. You can also use the host-to-host connections, use Swift. Swift isn't always that accessible to corporates, but there are ways, and we can touch on that very shortly, as to how that is being made more accessible by companies, by ourselves for one. But yeah, I definitely recommend using the Swift network or using host-to-host connections. There are things such as PSD2 solutions, but they're just not scalable at this point in time. There's just, each corporate would have to set up a PSD2 connection with every single bank, and not everybody's got the appetite to do that today. Okay. The next piece is the automated intraday and end of day reconciliation between your statement and ledger. So we've touched on the how you would retrieve that information. We're saying that actually it would be great if you could pull that information and see intraday what has happened, what hasn't happened, and also what were you or weren't you expecting. And a way of automating the reconciliation around that is really imperative. You can do this in a manual basis, but once again, it's just not scalable. You'll need more manpower if you were doing this manually, because going through a bank statement and comparing that to your ledger is rather time consuming and is fraught with error, I would say, human error that is. So a way of automating that reconciliation is imperative if you want to make your forecast scalable. Inclusion of historic data points. So this is truly maturing your forecast here, and this is where we're saying, by using historic data points, we're able to see if there's any seasonal trends, see if there's any daily, weekly, monthly trends with your data, with your forecasts, and then identify whether you can tweak your forecast depending on the time of the year or which day it is.
So I assume that in order to use historic data points, then you're going to need, you would suggest a particular period of time before you can get relevant data to identify those trends. What do you think the minimum requirement is in terms of historic data? How long do people have to go back?
Sure. So as one of our data scientists said to me, there's no point going back any less than 12 months. But the ideal for this, for cash forecasting and any sort of forecasting really, is going back 3 years. And the reason for that is because if we think about the 12-month cycle, if you do have seasonal trends, you can't really begin to identify those seasonal trends unless you have more than one data point for that season. So 12 months is only giving you one data point per season, where if you go back 3 years, you've got a minimum of 3 data points to identify if there is any seasonal trends, monthly trends, so on and so forth. And the final piece, which is going back to those historic data points, as we just said, is the analysis of the factors contributing to the discrepancies. So we're taking we keep on saying the reconciliation and the analysis around those factors as well. So there may be a reason why you have a delinquent payer. That reason may be their pay cycle for their own suppliers falls on a end of month basis, a last day of month basis. Looking at a single payment in isolation, you would just say they paid late. Looking at a number of data points which show you that a delinquent payer always pays on the final day of the month, you then begin to build up a pattern and be able to forecast when that delinquent payer will pay in the future. And it actually gives you more information and more insights into that person. So rather than spending your time chasing up a supplier payment, what you may be able to do is say, actually, we know they're going to pay at the end of the last day of the month. So my ledger says the 27th, really it's going to be the 30th. So it allows you to once again adjust your forecast in line with the information that you've gathered.
So at this point, let's just have a recap based on the playbook of what we're trying to achieve with cash flow forecasting. and there was 7 key benefits of an accurate cash flow forecast that we identified. So the first is access to higher yield liquidity solutions. So a lot of the short-term liquidity solutions that corporates seek to access, then you get a better return the sooner in the day that you can actually make those trades, and therefore you need a decent intraday forecast. Equally, some of the short-term solutions such as money market funds, you're going to have a decent accurate cash flow forecast because the trading deadline is around the middle of the day. So you certainly don't want to be over-investing, and equally you don't want to be under-investing. You want to be extracting the maximum yield from your balances. Secondly, we want to reduce the amount of idle funds left on accounts overnight. Most of the corporates that we've seen, Winston, are able to, once they implement a decent forecasting process, identify pockets of funds in accounts which are underutilised, potentially pertain to different legal entities that are underinvested or left there idle overnight, and generating a return on these pockets of cash once you draw them all together actually makes a significant difference to the return on equity for a company. On the flip side, then we all know that forward planning of structured debt financing makes it far cheaper if you can plan in ahead and agree official or committed facilities from your various providers. The next one is really around enablement of the C-suite and the executive management team of the firm. These teams want to be able to make informed planning decisions. They want to be able to rely on the information that's provided. And so accuracy in the cash flow forecasting is absolutely critical for them to conduct strategic planning and make decisions based on good quality data. Next, we need to be able to provide good cash flow forecasting provides an ability to manage key treasury tasks such as FX risk mitigation. It speaks for itself, but without a decent cash flow forecast, then your FX risk is going to significantly increase. We've covered this a little bit already, but identifying delinquent actors in both payables and receivables in the payment chain is absolutely critical because Treasury needs to be the guardian of that good quality data source and can only do that if people are operating within the defined parameters, providing good quality information and sticking to the processes and procedures that have been laid out. Finally, good cash flow forecasting encourages internal collaboration and a holistic approach to funding across subsidiaries and business units. So we've talked about building the relationships, building the lines of communication, building the connections, and particularly in geographically dispersed organisations, this is absolutely key. It's about moving from that decentralised treasury function to retaining the decentralised and local presences, but having a centralised process and procedure for forecasting, a centralised golden source of data and truth, and then encouraging the collaboration between the various different units.
So what's the secret sauce? We promised in the promo video that we would reveal a secret sauce, or at least some of the ingredients to that secret sauce, but what are they? So all the tips that we've just gone through are your base. Okay, we said right at the beginning that you can mature this forecast no matter what stage of automation you're at. It's important that you remember the fundamentals and the basics. That open communication, getting the information and consolidating that to the Treasury Department is essential. Add an innovative system to automate and provide scalability. Well, I'm going to make a shameless plug here and say that's what AccessPay do. We do have a cash management analytics tool called BankSense, and we allow you to move on your journey from inception, from starting off on your first steps to cash flow forecasting, and allow you to mature with the system all the way up until fully automated cash flow forecasting with those rich insights, with that data set, which it will allow you to continually improve the accuracy of your forecast as more and more data is analysed by the system. Okay. And the secret ingredient, what makes the secret sauce so good? We thought long and hard around this one, and we said it's the mix of connectivity options. So James asked, how would a corporate, how would a client get this information and automate it from the beginning of their journey to the end? And I gave a number of solutions. host-to-host, Swift API, PSD2 solutions, to name a few. What's important, and the big piece is, Swift isn't always obtainable for a lot of corporates. And the reason it's not obtainable is because of the cost around that, and the return on investment doesn't always appeal to all corporate customers. What we've done here at AccessPay is we've said, well, we can achieve all of the automation that you require through any of the connectivity points that you prefer, but we've also made Swift accessible. So what we've done here is we've gone out to Swift, we've had a conversation with them, and we've also got our own BIC. So what that means is our clients can use the Swift network using the AccessPay BIC, meaning there's no initial setup for data gathering with regards to your cash management information. So all of your end of day statements, all of that intraday activity can be retrieved using the AccessPay BIC into our BankSense application with no upfront costs and no ongoing cost to Swift membership, as that's something that we at AccessPay have ourselves.
And I think this is a really important point to just elaborate on a bit further, Winston, isn't it? Because there's a lot of talk at the moment about open banking, about PSD2, but to us here at AccessPay, then open banking to deliver benefits like enhanced cash flow forecasting is not about a specific regulation. It's not about a specific change in the market. It's really about how can we leverage all the new regulations, all the new tools, all the APIs that are emerging off the back of that, plus all the old systems to democratize access to information. Because forecasting really is just about how we intelligently leverage all of the existing data, get access to it, democratize that access so that people can develop these type of insights. And actually, when you've got a software supplier making all those connections, whether it's via traditional Swift or host-to-host rails, new APIs, under PSD2 or open banking, then you get that one connection from a software supplier and many customers leveraging it, and it's really bringing data to the organisations that you own anyway, but you've never been able to access.
It's definitely the case. Couldn't agree more. So on that note, we will move on to question time, our own version of question time. So we've got a couple of questions through. If James, if you could just read the first one, I will certainly try to answer. Okay, so we've got a few questions that have come through the webinar, Winston, so we'll start with those. Firstly, the first one that came through was from Chris, who asked, gathering information is easy for me, but I still use spreadsheets. What would be my next step in the maturity model? Sure. So if you can gather the information nice and easily, but you're using spreadsheets, then that's our basis of automation and moving on into the maturity. So rather than using spreadsheets, which are manual, fraught with risk, and we all know that a spreadsheet loves to corrupt every now and again, it would be really replacing those spreadsheets with a more one scalable and robust solution. And this is where you move more into the software space. So all of that information can be maintained, can be upheld within software, and then looking at software that can give you the flexibility to view your data in a number of different ways, rather than having to use pivot tables and try and cut the data any which way when people ask you for more information. So definitely moving on into a software solution to store that data and to view that data. Okay. The next question for you, Winston, comes from Alex. It's a good question. So he says, in the webinar you covered starting the forecasting journey and then moved into maturing the forecast, but can you give a bit of a quick overview on how do you reach fully mature forecasting? Sure, that's a good one. That's a doozy. No, sure. So we said how you would start it, in terms of getting your house in order, getting all your ducks in a row. In terms of moving on to mature forecasts, so we have the system. I made the shameless plug earlier, I'll do it again. BankSense, which is our cash management and analytics tool. And what this allows you to do is, firstly, it allows you to automate the data gathering element of the forecasting. So that's all of your morning balances, all of the opening balances, as well as all of the intraday feeds that you may use. It enables you to automatically reconcile all of those intraday feeds against your ledger, and then identify where you've received funds that you weren't expecting, or somebody's made a payment that you weren't expecting, and identify that in neon real time as the reconciliation happens. Moving on to a fully fledged mature forecast, here's where we need to start consuming things such as your 300s and your 320s, looking at those extra, the instruments that you're using in the market, and sewing those into your forecast automatically. So rather than having to manually adjust for these on a daily, weekly, monthly basis, as and when these things happen, consuming that information as the messages are out there, the information is available, as James alluded to, and then putting that into your forecast automatically. So really reinvesting, the treasury analyst's time, the treasury manager's time into analysing those forecasts, analysing that data, as opposed to just looking at the data, gathering it, and then putting the forecast forward, saying that's what I've got. Making that mature forecast is not only getting that data being the sources of liquidity and cash flows, but also automating how you view that, and then deciding what you're going to do after that. And I think that's the final step, is the action that you take with your forecast. And we will follow with a different webinar on what you do with your funds once you've got your forecast in there. But for now, getting the information and having an accurate forecast automatically is the key here. Hopefully that answers your question.
Winston, I think we've probably got time for one final question. So Mo submitted a question around if this is the ideal cash flow forecasting option, then does this work for both front and back office treasury teams? Where do you recommend this process resides?
Both, to be honest. And the beauty of cash flow forecasting, the beauty of BankSense as an application, again another shameless plug, is that it sits across both front and back office. There is a reason for that. The front office historically has always had a much more strategic view of the cash flow, where the back office has been a very, very operational, tactical approach, working day to day. The ideal cash flow forecast that works for everybody really has to span all of these departments, front, middle, and back office. And again, those open lines of communication allow you to do that in one system. So as and when the treasury analyst, the back office, is going into the system, uploading day-to-day activity, is seeing those daily feeds, that's also feeding the forecast for the front office, so that as they're getting more information in there, they can see that what activity is put in by the back office is immediately enriching the forecast of the front office, and vice versa. When deals are made, if we put some forward deals in there, you've got some maturities, that's also being consumed by the system and reflecting that for the back office, so that they can see, actually today we're looking short of funds, or tomorrow or in a week's time we're looking short of funds, and can then preemptively have that open conversation, front and back office, to discuss what solutions are available, whether that's going to be done over account, whether there's going to be another source of liquidity that is made available, or whether you need to go out into the front office needs to go out into the market and place funds or cover the funds in the market. So I think a holistic view, a single system that everybody has access to, and everyone's data is put into the same place, really allows you to feed the information, and it becomes information. It's more than just data; it becomes information with those valuable insights from all those using the system. Thank you.
Okay, great. Thanks, Winston. I think that's the end of the questions.
Great. So thank you everybody for joining the webinar today. We will be following up with the cash flow forecasting playbook. So those that don't already have that, you will have that very soon. And then I would just like to say, it's coming home. So yeah, we've got England playing on Saturday. So for those that are interested, it's coming home. Enjoy the rest of your day, everybody, and thank you for joining.